Let me be very clear from the start, this is not panic, and this is not hype. This is a warning based on data, timing, and structural pressure inside the silver market. If you are watching SLV or silver prices closely, the move toward 27 may not be the bottom, it may only be the beginning. What we are seeing right now is an unusual convergence of missing supply, ETF stress, and forced liquidation risk that deserves serious attention. 3 weeks before the enforcement action became public, the first signal appeared in a place most investors rarely examine closely: a routine holdings report. On the surface, nothing looked alarming. SLV still reported roughly 9 and 20 million ounces of silver, a figure that positioned it as the single most influential holder in the global silver market. But markets are rarely undone by headlines, they fracture along footnotes. A small compliance notation tied to an SEC review hinted that verification, not valuation, was becoming the issue. That distinction matters. Price can fluctuate without consequence. Asset existence cannot. When the SEC initiated a physical verification audit, the question was simple and binary: does the metal exist in the quantities claimed? Auditors did not rely on internal spreadsheets or custodian assurances. They conducted direct inspections across vaults in London, New York, and Toronto, checking serial numbers, bar lists, and legal allocations. This is the highest standard of verification in commodity finance. The result was stark. Only 533 million ounces could be physically located and verified as belonging to the fund. The remaining 387 million ounces were not delayed, misfiled, or temporarily unavailable. They were absent. From a financial perspective, this crosses a critical line. An ETF is not priced on intention or future acquisition, it is priced on assets under management that exist at the time claims are issued. A discrepancy of this magnitude, roughly 42% of reported holdings, constitutes a material misrepresentation because it directly alters risk, liquidity, and valuation assumptions relied upon by investors. This is why the SEC classified the finding not as a reporting error, but as fraud discovery. The hook here is uncomfortable, but unavoidable. The market was trading claims on silver that did not exist. For years, pricing, liquidity, and confidence were built on an inventory number that failed the most basic test of finance verifiability. Once that illusion breaks, the market does not adjust slowly. It reprices decisively because trust, once quantified and proven false, cannot be fractionally restored. The most critical element of this event is not the missing silver itself, but the structure that allowed the shortage to exist unnoticed for so long. SLV's reported holdings were split between allocated and unallocated silver, a distinction that sounds technical but defines the entire risk profile of the fund. Allocated silver means specific bars with serial numbers legally assigned and segregated for the fund. Unallocated silver, by contrast, represents a claim on a pool of metal held by a custodian bank with no specific bars set aside. On paper, both count as silver. In practice, they behave very differently under stress. The audit revealed that approximately 62% of SLV's reported holdings were unallocated, directly contradicting the fund's disclosures. This matters because unallocated bullion operates on a fractional reserve model. Custodian banks issue more claims to silver than they physically hold, assuming that only a small percentage of claim holders will ever request delivery at the same time. Under normal market conditions, that assumption holds. Under rising prices and institutional redemptions, it fails quickly. As silver prices climbed through 2024 and 2025, large institutional holders began exercising their right to redeem shares for physical metal. That is when theory met constraint. Custodians were forced to convert unallocated claims into allocated bars, but the underlying metal simply was not available in sufficient quantity. Instead of acknowledging the shortfall, internal processes shifted silver between accounts to satisfy individual verification requests, creating the appearance of coverage without actually increasing physical inventory. The hook investors often miss is this: nothing illegal is required for this system to function, until redemption demand exposes it. Fractional bullion banking is standard practice, tolerated because it is invisible during calm markets. It only becomes a problem when multiple parties ask the same question at the same time: where is the metal? Once regulators demanded simultaneous, multi-vault verification, the accounting logic collapsed. What remained was not a mystery or a market anomaly, but a structural failure rooted in how unallocated silver is created, marketed, and trusted long before anyone checks whether it can actually be delivered. The moment the SEC imposed a hard liquidation deadline, the silver market stopped being driven by opinion and started being governed by arithmetic. The order requires SLV to sell all verified physical silver, approximately 533 million ounces, by February 15. That single constraint defines everything that follows. Markets can debate value endlessly, but they cannot negotiate with time-bound mandates enforced by regulators. When an asset must be sold, price becomes a function of speed and absorption capacity, not long-term fundamentals. To understand the scale, it helps to anchor the numbers in real trading behavior. Global silver markets typically absorb about 8 million ounces per day across exchanges, dealers, and institutional channels. The liquidation order forces SLV to sell roughly 15 million ounces per day for more than a month. That is not incremental supply. It is a shock that exceeds normal market volume by nearly double every day without interruption. Even in highly liquid markets, that imbalance guarantees downward pressure because buyers know supply is non-discretionary. The hook many investors underestimate is how incentives shift once forced selling is recognized. Potential buyers do not rush in early. They wait. When the seller has no option to pause or withdraw, patience becomes a strategy. Bids are lowered, spreads widen, and liquidity thins precisely because participants understand that more metal is coming tomorrow and the day after that. This behavior is not panic. It is rational positioning against a seller with no leverage. The SEC's involvement amplifies this dynamic. Unlike corporate divestitures or voluntary ETF rebalancing, regulatory liquidation removes negotiation from the process. Block sales can soften the initial impact, but only briefly. As institutional demand is satisfied or steps back, remaining volume is pushed into open markets where pricing is unforgiving. The timeline compresses what would normally be months or years of supply into weeks, collapsing price discovery into a narrow window. This is why the liquidation itself becomes the primary driver of price, overwhelming narratives about inflation hedging, industrial demand, or long-term scarcity. None of those factors disappear, but they are irrelevant in the short term. When hundreds of millions of ounces must be sold by a fixed date, the market does not ask whether silver is valuable. It asks one question only: at what price will buyers step in fast enough to clear the volume before the clock runs out? The projection of silver falling toward 27 is not an emotional forecast or a bearish narrative layered onto a chart. It is the output of a constrained liquidity problem modeled by the regulator overseeing the liquidation. When the SEC evaluated potential outcomes, it did not ask where silver trade based on long-term demand or macro themes. It asked a narrower, more immediate question: at what price can the market realistically absorb 533 million ounces within a fixed, non-extendable window? The model starts with an uncomfortable reality. Daily global silver trading volume averages roughly 8 million ounces. Even under optimistic assumptions, increasing that volume requires price concessions. When supply exceeds natural demand, the only mechanism that restores balance is lower pricing. In the SEC's market liquidation scenario, sales are not carefully negotiated behind closed doors. They flow through existing channels, where buyers are aware of the seller's urgency and act accordingly. That awareness alone compresses bids. The hook investors struggle with is this: price does not fall because silver loses its utility or relevance. It falls because liquidity has a limit. When sell orders arrive faster than capital can absorb them, price becomes the pressure valve. The SEC's modeling reflects this dynamic by stepping through progressive buyer exhaustion. Early in the liquidation, some institutional buyers step in, expecting value. As volume continues and prices slide, those buyers step back, either fully allocated or unwilling to catch a falling market. Each step down requires a new class of buyers, and each class demands a lower price to participate. Under these assumptions, the model converges near 27 as the level where sufficient demand finally appears to clear remaining inventory. This is not a prediction of where silver belongs long term. It is a clearing price under stress. That distinction matters. Markets under forced liquidation often overshoot intrinsic value because participants are pricing time risk, not asset quality. The SEC's conclusion reflects historical precedent as well as market mechanics. When volume urgency and transparency align, prices do not stabilize where investors feel comfortable. They stabilize where the last unwilling seller finally finds a buyer. What makes this event especially destructive for investors is that it does not confine losses to a single vehicle or strategy. It affects every common form of silver exposure at the same time, removing the usual avenues for risk rotation. In normal market drawdowns, investors shift between paper instruments, physical holdings, and equities to manage volatility. Under forced liquidation conditions, those distinctions collapse because the same underlying pressure drives all three. For SLV shareholders, the damage begins with the structure of liquidation itself. Shares are no longer a proxy for silver exposure, but a claim on a shrinking pool of assets being sold under distress. As liquidation progresses, SLV trades at a discount to net asset value because buyers price in the risk of being last in line. That discount compounds losses, meaning investors are hit both by falling silver prices and by structural inefficiency inside the fund. Physical silver holders often assume insulation from paper market failures, but forced liquidation reverses that assumption. The influx of large, distressed wholesale supply overwhelms fabrication and retail bottlenecks. When dealers can source metal at or below spot in institutional size, retail premiums compress rapidly. Investors who paid elevated premiums during high price environments experience a double loss as spot prices fall while premiums evaporate. The hook here is uncomfortable but factual. Physical ownership does not protect against price destruction when supply shocks originate from liquidation rather than scarcity. Mining equities magnify the effect further. Silver miners are leveraged not just to price, but to margin. When silver trades at elevated levels, operational leverage works in their favor. When prices collapse, that same leverage accelerates losses. A drop toward 27 compresses margins to levels where many operations approach break-even or worse. Equity valuations, which are based on future cash flow expectations, adjust rapidly. The result is not a proportional decline, but a nonlinear one where stock prices fall far more than the underlying commodity. The critical hook is this: diversification within a single asset theme does not reduce risk when the shock is structural. When liquidity, pricing, and confidence fail simultaneously, exposure becomes binary. Investors are not choosing between safer silver instruments, they are choosing whether to remain exposed at all while the market is forced to reprice under conditions that do not reward patience or conviction. The most far-reaching implication of this event is that it does not stop at a single ETF or a single custodian relationship. The investigation exposed a structural feature of the bullion banking system that extends across institutions, products, and jurisdictions. Unallocated silver is not unique to SLV. It is a foundational component of how large volumes of precious metals are intermediated in London and other financial centers. SLV's collapse simply made the mechanism visible. Custodian banks issue unallocated claims to a wide range of institutional clients, operating under the assumption that delivery demands will remain limited and staggered. This allows multiple claims to exist against the same underlying inventory. Under stable conditions, the system functions because claims are rarely tested simultaneously. The SEC's findings show what happens when that assumption breaks. Once one major vehicle is forced into liquidation, other claim holders begin to question the integrity of their own exposure. The hook here is contagion through awareness. Institutions do not need to experience a loss firsthand to change behavior. They only need proof that the structure is vulnerable. When large pension funds, sovereign investors, or hedge funds realize that unallocated holdings may represent claims rather than metal, the rational response is to seek allocation, demand delivery, or exit entirely. Each of those responses increases pressure on custodians already operating with fractional physical backing. This dynamic creates a feedback loop. Requests for allocation force banks to source metal they do not have. Attempts to source metal drive prices temporarily higher in isolated transactions, but ultimately fail when volume overwhelms supply. Exits through secondary markets add selling pressure, not relief. Legal action introduces further constraint as assets are frozen or reclassified. None of these paths restore confidence quickly, they all strain liquidity. What makes this systemic rather than isolated is scale. The SEC identified unallocated silver claims that exceed available physical backing by multiples, not margins. Once that imbalance is acknowledged publicly, trust erodes across products that share custodians, vaults, or accounting practices. Markets price that erosion immediately. The system does not require universal failure to destabilize, it only requires enough participants to stop assuming that paper claims will convert smoothly into metal when it matters most. So the message here is simple but serious: pay attention. The silver market may be approaching a moment where structure matters more than sentiment. A move to 27 may feel extreme, but under forced liquidation conditions, markets often move further than logic suggests before stabilizing. This is not a call to panic, and it is not financial advice. It is a reminder that informed investors survive volatility by understanding how markets actually function when pressure builds. Stay disciplined, stay educated, and most importantly, stay ahead of the risk, not behind the price.